All right, good afternoon, everybody. Welcome to the Real Invest Webcast episode 005. This is Joseph Olatirigun. Welcome you to the show from South Ontario here in Niagara. It's awesome to be with you today. Once again, my name is Joseph Ola. I am the host here of Real Invest Webcast, where we try to educate you on how to build wealth using the vehicle of real estate. This is the fifth episode, and I'd like to thank you all for joining us today. Thank you for those who have been with us since the very first episode. Please like the video wherever you're streaming from, Facebook, Instagram, or YouTube, and make sure to subscribe on YouTube as well so we can reach out to many other people that needs these vital information. My guest about a couple of episodes ago said that 90%, which I believe is a common fact that's published out there, that 90% of millionaires in the world today are invested in real estate. Think about it, 90% of them. So why shouldn't you be invested in real estate? So it's vitally important that you pay keen attention to what we'll be discussing today. One of the things that you've noticed also in the past few episodes is that most of our guests on the show will tell you that their primary bottleneck or hindrance of getting started initially had to do with their ability to finance their deal, which is our main topic for the day. So I'm glad that you're here with us, and I'm glad that you're going to be taking a lot away because I have a very special guest that I'm about to welcome right now. Once again, like the video, subscribe to the channel, and make sure you share with your friends and loved ones. Today, I'd like to welcome my guest. Mortgage by Dammy. Her name is Dammy, and she's really doing a lot in the mortgage scene. She's well. I've been following her feed for quite a while, and I've seen that she has a passion to educate her clients with regards to financing real estate deals. So I wouldn't want to give too much away because she's going to be introducing herself. So welcome, Dammy. Thanks a lot for coming on the show.
Thanks for inviting me. Nice to be on your show.
Great, great. All right. So for the house here, can you just introduce yourself?
Okay. My name is Dammy Aromiwura. I'd like to start by I'm passionate about real estate, and I noticed that a lot of the challenges with for people to be invested in real estate is the financing part. I've grown up like loving numbers. My background is in economics. It was like a natural fit for me to go into the space. And since I started, I've really enjoyed it. I've helped lots of home buyers purchase their first property, their fifth property. I've even helped a lot of people that are even going into like the private lending side of things. So that's about me.
That's good. That's good. Yeah, for you guys to know, actually, it looked like we both come from a tech background. I was also a software quality assurance manager, so it was interesting to see her to transition from that field into real estate. Now, like I said earlier, number one barrier for people to get invested in real estate seems to be securing financing. Now that homes are pricier, that means that higher down payments required to buy a property. What are some tips that you would offer your clients on how to come up with those hefty down payments these days?
Okay. So yes, down payment is the most challenging, especially for first-time home buyers. So for first-time home buyers, I would say saving as much as you can. And I know sometimes it feels impossible to save more because you have rent, you have daycare, you have all these other expenses.
Hmm.
But I think that just looking at your finances, if you make something like your priority, like I want to buy a house in the next 1 year, that could mean like reviewing your finances to find other ways to cut, places to cut. It could also mean like picking up a side hustle or picking up a second job just to save for the first down payment. And once you save your first down payment, which can be as little as 5%, there are some people that come in to the market with 20%, but getting into that space then gives you opportunity later on to leverage on the equity that you built in your first home as your down payment for other houses. I always say the first challenge is getting in, and as a first time home buyer, you don't have equity to leverage on. So the honest truth is that you have to just save as much as possible, and that sometimes that means picking up other opportunities in a way so that you can come up with that down payment. Once you come in, the second category of people, they've gotten into the market and they're just sitting comfortably. They have this equity, they like to see it, but they are not necessarily leveraging it. So I think that if you want to be an investor, and I always say, even if you want to pay off your mortgage faster, it's really like leveraging on that equity that you really have, and you can actually use that as down payment. You are now in a better position because your down payment is not limited to your savings alone. You now have your savings and equity that you built in your property.
Hmm. That's true. Now back to that those first category of people. I've seen different people that are currently renting, but it seems that right now they'd rather just stay that way, and they stash a lot of money in, let's say, RRSPs or different other creative financing, because they don't really, many of them, their goal is to secure their retirement, so they don't want to get risky, so they think that maybe RRSP is safer. uh in that case, is there a way for them to leverage those kind of savings for mortgage, and does that sabotage their retirement?
Good question. So yes, if you have RSP, I would say if you're a first-time home buyer, it's a great way, a place for you to save. The advantage is one, if you are, let's say, RSP that is benchmarked to the market, you're getting your savings plus whatever returns you're getting in your RSP. And also by contributing into RSP, you're probably like forcing some type of tax returns. So if you have 30,000 that you're putting towards the RSP, you now have 30,000, you have the gain on 30,000, and you also have the income tax that you've saved by putting your money into your RSP. So I would say it's a perfect opportunity for you to use that money and use it towards your purchase. In terms of the people that are saying, well, I'm going to invest in um, stock market, I'm not going to purchase a house. Yes, the first 1 year, 2 years, sometimes rent is cheaper than owning, but like the longer you wait, the more expensive it becomes. And even for retirement planning, I always say owning a home is one of the great things that you can do for retirement planning. When I see like some older clients, they are at retirement, they don't have lots of income coming in. There are so many things we can do. We can take out equity from their home and they can actually live off that for
Hmm.
mortgage. We can do a reverse mortgage. It opens a lot more doors from a retirement planning perspective if you own your place than if you don't own your place, especially at that age.
That's right. And I noticed too that even if you were not looking to build a portfolio, it seems that banks, they kind of look kindly towards someone who own a home when it comes to maybe financing any other project outside real estate, maybe business or things like that. Once you have, it looks like that first home is key to opening up quite a few doors.
Yes, I believe so. Once you have a home, long term, you are building, your net worth is increasing. I've seen studies where they are comparing net worth of homeowners versus net worth of non homeowners. And I know it's a bit biased because if you're an homeowner, you're actually already more likely to have higher income. But when you don't even factor the income in, the net worth of homeowners are higher because we're not only banking on your income or your savings, we are now like pretty much banking on the markets, which also means that you're building equity over time. And at
Hmm.
retirement, you can actually live off your equity. And if you don't need to live off your equity, you can actually pass something on to your kids. Because imagine how difficult it is right now, and just imagine, hopefully, it becomes easier. But I don't know any market that's become easier over time. So it also
Hmm.
allows you, if you don't need to live off of it for retirement, also give your kids something or like your family members something to at least a place to start off. You can use it towards
Hmm.
their school fees. It's just good financial planning for you to start as soon as possible. And all those brain buy calculators, I personally don't believe in it because you're looking at the full potential for owning your own cannot be boiled down to a calculator. So I always say just get in as soon as you can and where you can afford and just wait over time. The benefit actually grows over time.
That's right. Yeah. I constantly deal with people who kind of treat real estate as a moving target. It looks like today they eye a particular property and it's above their qualification, and they decide to wait until they can qualify for that amount. But once they wait a few years and they qualify for that amount, the value of that particular property has moved. So it's like getting where you are, and then it works itself out nicely over time.
Yes.
But the other side of the coin, I guess, is for those who besides the down payment, you still need to qualify for the mortgage, right? So for because the prices are quite exorbitantly high these days,
Yeah.
what are you how do you advise your clients in terms of, what to do based on the high prices of homes if they don't qualify for much?
Especially in Ontario, when you say people don't qualify for various reasons. Some of the reasons I've seen, let's say the income is just not high enough that, let's say you live in Toronto and you qualify for 350 or 400, like you cannot just find. Maybe you can, but first, I don't know of a way you can find a place to buy in Toronto for 350 or 400. But that could mean that you might look into other markets where you can actually get in at
Mhm.
that moment. And it doesn't mean that you have to stay there for 50 years. It could just be like your entry point and you leverage on that to then buy at your preferred locations. I think it's like thinking outside of the box. Yes, I qualify for 400 today, but where can 400 get me? Does that mean I have to move a little bit outside of Toronto? Does that mean I have to move outside of the province, maybe just for a few years? But if you
Mhm.
make it your priority, I want to get in something, knowing that it's not necessarily going to become easier over time. In fact, mortgage rules are tightening, prices are rising. So
That's right.
based on history, it actually becomes more difficult over time. So get taking what you have and then getting into the market where you can afford, I would say is the best way to qualify. And if you don't qualify for some reasons like self-employed, for example, they calculate their qualification in a different way. Sometimes it could mean looking at alternative lenders to help you get into the market. So wherever you are, there could be some type of strategy that we can put in place to help you get into your home faster.
That's right. Yeah. And one of the things I try to get potential buyers to do is look around and see who they can uh, purchase with so they can co-own a property, right? Sometimes, yes, in this day and age, everybody wants to do things independently. You don't want to have to be tied to anybody. But a lot of times, so you stand a better chance when you come together with someone and join efforts. Down payment wise, you could come together. And in terms of qualification as well, if one person qualifies for 300 and you have another person, a friend, a partner, a sibling that's unmarried, you come together and buy. And there are a lot of families that I've seen around too, especially some Asians, Easterners that it's a lot of family in one house anyways. So for them it's the norm, but I guess it's something that everybody needs to kind of consider in this day and age where a typical graduate from the university would hardly be able to qualify for something, for example in Toronto, like you said, right? I mean, a well paid bachelor's degree holder from U of T would probably earn about 100,000. That's well paid, I would say, right? And ha- it, barring other things, everything looking good, how much are they going to qualify for with 100,000?
Yeah.
I don't know. Obviously there are many other factors, but maybe somehow they qualify for 400 or 500,000. In Toronto, yeah, maybe they'll be
Yeah.
looking at a condo in Etobicoke or something. you know.
Yeah, that's
Yeah.
actually a very good point. I'm actually seeing more of that now. I have an application where two friends they are individually renting their condo. They are paying about 2,000 per month, and they have both come together to put down 40,000 down payment. They are buying a two-bedroom place and they are staying together. I've seen like families also coming together. They both have their own homes. They have some equity, but it's not enough to buy what they want, and they are both bringing that equity together, and they are both purchasing a rental property. So that's a very like important point. Even if you cannot do it alone, if you have somebody that you trust, you can also look at opportunities to either buy owner occupied home together or maybe buy an investment property together.
Yeah. And let's say 5 years down the line, the homes are appreciated. Throw a number out there, 200,000. I mean, with 100,000 down payment each, I think it's the possibilities are much stronger that they can both now invest individually or buy their homes individually. So yeah,
Yeah.
leveraging what you have to get what you want, and sometimes just taking on a little bit of discomfort for it is well worth it for the future. So mortgage rates are on the high, on the rise. Obviously, that's the hot topic right now. I'd like you to talk about that. What are the current rates right now? What's the previous rates, and what do you think is about to happen in the future? So just take us through what's happening in the market right now, trend wise in the past little while, where we are right now and where we're heading.
Okay. Not my favorite topic right now because the rates are like crazy. But for let's start with fixed rates, right?
Mm-hmm.
Pre-COVID, fixed rates were about high 2 to 3%. On
Mm-hmm.
January, right before COVID started, um, the rates then dropped significantly. That there were actually people, there were offers for 1.5 fixed over 5 years, which is unbelievable. Even variable rates dropped to like bare minimum. There was 0.99 variable, 1.15. So those were like historic lows. And
Mm-hmm.
we kind of got used to that. Especially first time home buyer. The first time they are thinking about rate is like 1%. So they're like, okay, this is really cheap. It's lower than inflation. So now that rates are starting to rise, if you are fixed, you are kind of safe for the next 2 to 3 years because your rate is stable. But a lot of times, at least Bank of Canada is predicting that if you are at the time of renewal, you are probably renewing into like 4 point something percent, which is the going rate as of today. And if you were variable, it's still much lower than fixed, is less than 3%. It's been increasing, and that's where you've seen a lot of media around that. But most likely to also keep increasing upwards, is around that 4%. So to be a bit on par with very fixed. So as of previously, rates were on average 2 to 3%. COVID happened, it dipped to 1 point something, and
Mm-hmm.
now the rates are now on the rise. And it's actually, at least right now, fixed rate is at a 15-year historic high. So really high. Fixed, I don't think fixed. I think it's gone to the point where I don't think it could go up any further, but don't quote me on that. But
Yeah.
where we are, I think fixed have gotten to that peak, but variable likely will keep increasing. If you're a new home buyer into this market, should you lock in at fixed of 4.5% with a guarantee that you're going to stay there for 5 years? Or should you lock into 2.8% variable, knowing that there might be a chance that the rates would increase to
Mm-hmm.
4 point something? I think right now I'm recommending that people go variable because yes, it's going to increase, but I don't think it's going to increase much more than fixed. And the thing with fixed is that if you're locked in, even when the rates drop, you can't take advantage of that drop. You're just like
That's right.
stuck in for 5 years. So that's kind of where rates are right now. The other effect on the rate is not only that it's increasing how much monthly payments that you're making, the other effect is that it's actually reducing people's purchasing power.
Mm-hmm.
Canada, we have something called the stress test. When rates were very low, like 1 point something, we're qualifying everybody based on 5.25. This means that you can, let's say, buy 800,000 home. Now that rate has increased, we have to qualify you based on the current rate plus 2%. So I'm saying 7.5% qualifying rate. So someone that qualified for 800K 4 months ago, they probably qualify for around 700 or even 650 right now just because of the rates. So two effects, higher monthly payments and in some cases, lower purchasing power.
Right. So I had a client who was on a dilemma not too long ago, and the bank was advising her to go fixed because the rates are going to go high, but she couldn't make the decision because the fixed obviously goes higher, and that means that her monthly expenses goes up to a point where she couldn't really uh she didn't want to go that route because she didn't want to spend that much at that point in time. So she was basically stuck thinking, okay, what should I do? Should I take on the extra right now in hopes that the market doesn't in hopes that the market is going to go much higher and then I'm safe, or should I stay with a variable that has a potential to rise, but the hope there will be that it doesn't rise
More
beyond,
than,
yeah, exactly. So it's, I mean, it will take a crystal ball, but what's your take on that kind of decision? I guess you kind of alluded to an answer
yeah.
already.
I think it also boils down to personality. There are some
Hmm.
people I know, they just want to know their monthly payment, their interest rate, and lock that in. Not have to worry about it for 5 years. I always say it depends on your budget. If you're someone that the way your budget is set up, you can't like $100 increase may mean you not being able to like afford a home or buy or buy food for your family, I would say maybe fixed might be the better option for you. For variable rates, yes, the rates might potentially go up more than 4.5, which is the average fix right now. But based on history, even when the rates spike, you also see that very short after a short time after it comes down. It's like a literally V shape. So while locking at the peak, variable could go up. I don't think it will be there for over a year, over 2 years. We're already kind of like on the bridge of recession. And what happens in a recession? The government drops the rates. So for somebody like that, depending on how risk averse you are, I'm recommending that you do variable and just watch how things go. Just knowing that there might be a potential it goes to maybe 4.5 or 5% or 6% at some point.
And I guess you've while you're still at variable before the variable goes up, at least you've saved a little bit,
Exactly.
right? Rather than, jump when you don't necessarily know what's gonna happen really,
Yeah.
you know.
And if you can actually, something else, if I see someone that really prefers fixed and they're concerned about the increase, we can actually do a variable at, let's say, 2.5, and then we set your monthly payments as if you're on a fix of 4.5. What that allows you to do is that you build a buffer because you're paying a lot more than you should be paying. And if the rate then increase, you probably don't even have to increase your monthly payment because you're already paying as if your rate is 4.5. And you're also saving because you're paying a lot more into your mortgage. So that could be for someone that is really concerned about their rate increasing. You can
Hmm.
do variable, but start to make extra payments right now to build a buffer for when rates do increase.
Wow, that's yeah, I never really thought of that. I didn't know that that was a thing. So, yeah, thanks for sharing that. For everybody who's joined us in the middle of the show, this is Real Invest Webcast, episode 005. And here we're looking to educate you on your real estate investment journey, hoping to help you succeed at that. My name is Joseph All, and my guest today is Dami. And her specialty is to make sure that you get enough money to buy your house. She is the mortgage guru, and she's been dropping a lot of golden nuggets here today. So please make sure you're attentive, and please share and like and subscribe to the channel. Thanks a lot for coming on board. And we go on as you were talking about that, Dami, about the buffer. I was thinking too that there are times when, especially someone like me, I'm a realtor, and my income is not necessarily fixed on a monthly basis. So one of the things I try to think about is how do I kind of manage things, especially the fixed expenses. So I know that you just explained that you could do a buffer. I also know that typically every year there's a certain allowance that you have to kind of pay up on your mortgage. But are there typically ways for you to, I guess, my question is, if I'm paying in advance right now, could I literally just pay the next 6 months of the year without necessarily I'm not paying it as an additional payment. I'm literally just paying for the next 6 months of the year rather than having that money held in an account where the money is coming out from on a monthly basis.
Yeah. So that's called like prepayment privilege. So this actually varies from bank to bank or lenders. So there are some lenders that will allow you to prepay up to 20% of your mortgage each year, some 10%. It varies from 10 to 20. So yes, that could be a potential as well. You can prepay your mortgage by, let's say, 6 months. But I think there the decision is now like from an investor perspective. Like yes, you are prepaying 6 months of payment, which is quite a lot, and that allows you to save what 2 to 4%.
Hmm.
So, are there other investments that you can do that will bring you more than 2 to 4%? I think that would be like the trade-off. Yes, you're locking in that money for the potential of one saving in interest, but in your case, you are looking at it more from like an expense management perspective, or could you put that amount of money in an interest generated account and just wait for the increase to come in and start using that money to make the top up?
Okay, so I want to make sure that I get you correctly. This prepayment privilege you're talking about, though, the way I saw it before was that when you do prepayment privilege, it basically just goes straight in towards your capital. It doesn't mean that you get to skip any other payments. Is that
No,
right?
your payments remain the same. But when the rate increases, the
Hmm.
way they calculate how much you should be paying now, it's actually depending on how much you've paid over time. But because you've paid extra you may not actually have to increase your payments because now you've built a buffer. Again, this varies, but most institutions are like that.
So the case I'm asking about specifically now is that rather than paying monthly, I
Hmm.
want to get the next 3 months, or I want to get the next 6 months out of the picture.
Oh, I see what you're saying. Okay, so you want to pay. Okay.
Is
So I'm not saying for private alternative lenders, there are options for you to pay upfront.
Mhm.
But for traditional lenders, I think the max I've seen is monthly payment. So bi-weekly, monthly, or weekly. So I
Okay,
don't think there's a case where you can pay now and then skip payments for the next 6 months.
for the next, so the I guess the solution is still get a separate bank. I can put the money in there, let the money get a little bit of interest while they're drawing out their mortgages, right?
Yeah.
A question came in here right now. Let's see if we can address it. That's from Humphrey. It says, why is paying biweekly less than paying monthly when you put the total of the biweekly payments to the full month's payments? Biweekly is always lower. Is there a disadvantage to this?
Okay. So this is actually a misconception. So for bi-weekly payments, if you add up all the payments over 1 year, it's 26 payments. But for monthly, that's 12 payments or semi-monthly 24 payments. If you
Mm-hmm.
look at the difference, you save slightly because you are paying your mortgage principal on a faster basis. But sorry, let me read the question. When you put the
Okay.
total bi-weekly,
Okay.
yeah, okay. I've actually answered your question. Why is paying bi-weekly less? It's actually because you're making for bi-weekly, you're making 26 payments. Whereas when you're paying monthly, you're making 24 payments. If you divide 12 monthly payments, if you divide it by like every 2 weeks, that's actually 24 payments. So
Wow.
it's not necessarily less when you look at it over the year, but if you do times 24, you're not calculating properly. You should be doing times 26.
Hi. Okay. Good to know. So at the end of the day, it's still the same thing. If your amortization is 30 years, it's still 30 years, so you're paying in the same thing.
Yeah.
Okay, good. All right. If you have any other questions, people keep it coming. All right. Back to the topic of what's going on right now with the mortgage rates and all. Why are the rates rising right now?
Okay. Um, the rates are rising because prior to when COVID happened, we were pretty much in like a recession.
Mm,
In order for the government to boost the economy, they put tons of money into the economy. They reduced the rates, which is a way for you to boost the economy. Those things that they've done has now led to high inflation. So now that the inflation is really high, of course, what happens when the inflation is really high and the government is trying to bring inflation back to 2% is we are in a period of contractionary monetary policies. I don't mean to sound very technical, but in a contrary period, what they are doing is increasing the rates. When they are increasing the rates, we are not buying as much. Maybe consumer confidence is too high during inflation. By increasing the rates, you can see businesses are borrowing less. House potential homeowners are not buying as much. Investors are thinking twice because the cost of borrowing is much higher. So we are in a period where the government is trying to reduce um, inflation, and that's synonymous with increasing rates. And I know you've seen in the news also all prices are super high right now. A lot of everyday consumer goods is expensive, grocery. So inflation is really high, and the government is trying to curb inflation by increasing the interest rates.
okay. This is it's sometimes very important for people to understand the dynamics. What would you say is the I know you talked about the influx of I guess money into the markets with the government trying to support the population, and then that led to inflation. So, in if we boil it down to basics, so that a layman could understand, in terms of, let's say, supply and demand, what exactly does inflation look like?
Okay.
What's the dynamics of inflation in terms of supply and demand?
Okay. So inflation just means that prices are rising at a rapid pace. So that's
Hmm.
inflation. So now when prices are rising, things like income are not rising at the same pace. So you risk now that for the government to actually maintain the economy, they might have to print money. It means that things are not as, if something was worth maybe $20 last year, if it's now worth much less, you don't want to be in like a scenario like that. And I know like people from, maybe if you're from Nigeria as an example, you've seen situation where the money is pretty much not worth a lot. You have to put it in a savings account, at least that matches the rate of inflation for your money to value to actually remain the same, or you might have to put it in a durable good. So inflation is not necessarily a good thing for a stable economy.
Hmm.
Prior to right now, Canada's inflation has actually stayed around 2%, which for a strong economy, that's an average, because you want some things to grow. You don't want it to grow too much. But right now, Canada's inflation is around 6.8%. That's more than triple. If
Wow.
that continues, that's it's not good for the economy. So that's why they are really trying to return average inflation to 2%, which is what the target inflation rate is.
Okay. Yeah, that's enlightening. So I need you to correct an assumption that I kind of cooked up in my head because in inflation, prices are going up. And I'm thinking, why exactly? What's the force behind price going up? And when I think about supply and demand, to me, it kind of seems like it's either people really need the stuff they're trying to buy so that the demand is high, or it's that they can afford to buy more. So there's a lot of money in their pocket that they can afford to spend. So basically, there's a lot of demand, and the supply has not gone up at all, or it's dropped, and because of that, prices are being driven high.
Yeah.
What would you?
I think you can look at it as demand for money and supply for money. The intersection is
Hmm.
the interest rate. So when the interest rate is a bit lower and the supply in this case is low, you can see like where your price meets. But in
Ah.
this case, where we had a lot of demand, but the demand is also fueled by the fact that interest rate is really low because the cost of borrowing is lower. Like when rates were 1%, 1.5, you are literally borrowing money for free because inflation. If inflation was 2%, um, that would make a lot of financial sense.
Mm-hmm.
But when rates increase, now you have to look at it. What's the demand at that rate point, and at that point the demand is lower because now people can't justify it. Then maybe rent looks better, or maybe now you noted that all the markets are kind of interrelated, right? Housing market is low, you notice stock market is low, crypto market is low, job market is following because you've seen a lot of layoffs. So
Mm.
yes, and wait. So some people will say, "Oh, should I just wait for a recession to buy a place because at those times prices are lower?" But during that recession, are you going to have a job? Because based on the market, those times also mean that people like have more layoffs. There's lots less job opportunities. So the market is interrelated, but I think the driving point is really the money because businesses need money to grow. That's why they have to hire employees, and that will then go into like demand for things like housing and other durable goods.
Mm. Yeah, very interesting. Again, I actually had a client reach out, and that was the exact thing he was saying, that you know what, yeah, if we get into a recession, there will be plenty of opportunities to buy. Well, that's sometimes the main issue because you cannot catch the bottom of a price chart.
Yeah.
Yeah, when you're waiting to catch the bottom, then it just turns back up again, and do you have to wait for another 5 years before you purchase? So it's always a moving target.
And
I
even when
will
you catch it, are you going to have the money to buy?
exactly, yeah, because
Like,
when
you
we're in a
job, like, are your investments going to still be at the same point?
right.
And at what price? Because now the qualification power is lower because the rates are higher.
Mhm. So right now, uh, I asked earlier about what you think, and you're thinking it may not go much more higher than where we are right now, but nobody knows, right? But that's your general inclination.
Yeah, I think fixed rate won't go much higher than where it is right
Hmm.
now because based on history, we're at a really historical high. But I think variable is going to go up, probably to be on the same pace as fixed because the differential between the two rates is still quite large right now.
That's right. Okay. So in general, then thinking about all this and also considering a scenario where things even goes higher, the question is how do you suggest that an investor or just a typical homeowner who's looking to maybe even upgrade? what are the parameters of safety that they need to set around themselves to make sure that they are safe through, let's say, even if the market just decides to, if things go get worse with regards to interest rate, or there's a recession, what is the proper positioning for both a regular homeowner and an investor?
I think if let's say a first time home buyer, and I try to differentiate between first time home buyer and somebody that is buying like their next property, for example.
Mm-hmm.
In your case, let's say because of inflation, if you had 20,000 in savings, 20,000 today is going to buy you way less. So that also tells you you can't just keep your money in the back savings account and not buy um, something, not buy a property or even stocks or something with it, because at least you want your money to grow at the pace of inflation. So I think
Mm-hmm.
for the first time home buyer, if you are moving in and you're not planning to sell anytime soon, you're buying it more from a home perspective, I think it's still a good time to buy. And like any market, you see fluctuations, but over time, look at it from like a long-term perspective, the market always trend up. Yes, in the short term, they can go down. So from a first-time home buyer, even any home buyer, if you're planning to live in it for a really long time, or you just want to live in it and see what happens, I think it's still a good time to buy. If you are selling your home to buy another, right now, say like try to do both at the same around the same time, because you don't want to sell first. And what if your buyer cannot close, which has seen happen more now because of appraisal issues? Or even if you buy first, you want to make sure that you can actually sell your property. And but if you are buying, if you are selling and say, okay, I'm just going to wait and see what happens, you can actually remain in range. So you can't really the market. I believe that this timing in market, timing the market over time in the market. From an investor perspective, it's a bit more tricky because of flips. Just as an example, someone that bought a flip property in February, and you're hoping to sell because of the first appreciation you've done by fixing the property so you can sell. The thing is that it's a bit tricky right now because even after that appreciation, because the prices have dropped by so much, you might not be able to sell for profit. So now you might be forced to keep it for longer. So I think if you are trying to flip, you also want to make sure that do the math. Like if the market drops by 10%, 20%, does it still make sense? And you have a backup plan to say, okay, even if I don't sell, maybe I'll convert it to a rental. So you just want to do more analysis with some worst case scenarios to see if it still makes sense to do a flip right now.
Hmm. Yeah, do some analysis. One of the things that we talk about on the show is be knowledgeable about the deals you want to get into, or about the investment strategy you're looking to work out with. Make sure that you have multiple exit strategy. You want to flip. Okay, what if you can't sell it right now? Can you buy it? Can you turn it into a buy and hold? Can you get creative and make sure that you're not stuck in the rut? So that's a really good one. We've talked about potentially, you know, getting in or waiting, and really, the best time is always now. Even if you buy and you feel like you bought at the peak of the market before it dropped, the history says that it drops and it rises back and it keeps on going, right? So sitting on the sidelines is just never the good option. How would you talk, leaning in a bit into an investor's path right now? How should an investor structure their finances to be able to, leverage it the most to make sure that they can maximize what they can qualify for? Because obviously, again, finance is really key to an investor being able to grow their portfolio. And more often than not, sometimes, I was still talking about that before we began the show, that right now I'm kind of maxed out and I'm looking to, grow my portfolio. So what are the ways to get creative around that and be able to purchase more property?
Okay. So I think that there's always a way. Is like, what's the cost?
Mm,
So if you have your down payment, there you can still probably buy, but now at what rate? And you have to see if it's still profitable for you to go into
mhm,
that investment at what rate. And something that I've seen other investors do, if then you have to look at your portfolio here. Like typically, if your portfolio is either neutral or cash flowing, it doesn't affect your qualification for the
mm,
next property because it's kind of the property is paying for itself. But if you have a portfolio where the property is not paying for itself, can you refinance or like can you restructure it a little bit just so that you're able to purchase the next property? Or maybe instead of doing your investment calculation with 3%, maybe now do it with 6% and see if it still makes sense to go into the investment. And there are also other opportunities like reconstruction. You might want to look into other investment strategies to see if now is the best time to go into those or not.
That's right. In my own case, there were times when it just looked like, things are quite maxed out in pre-construction, which didn't require, qualifying for mortgage was one of the vehicles I turned to. So that's a very good one right there. Again, for everybody that joined us in the middle of the show, this is Real Invest Webcast, and with Mortgage by Dammy, talking about how to make sure that you're well positioned for the shift that's currently going on the market. She's a very good mortgage agent that has a lot to offer you. So if you're looking to, finance a new deal, or you currently own a property, you're thinking about maybe buying another one, but you want to know how much equity you can pull out and still be safe. All of these kind of questions are things that Dami can answer for you. So please make sure to capture her information at the end of the show. And please like, share, and subscribe to the show on YouTube, on Instagram, on Facebook. It does help us reach out to more audience and to educate more folks. Um, right now, when you own a bunch of property in the middle of a recession and you're wondering by the way, we're going off script a little bit here, but I'm trying to think about the long term for an investor. I've seen different investors talk about different things, but uh, at some point, an investor wants to be less active in the market. What are ways that you would suggest to get creative with regards to structuring your portfolio so that you're more, let me say, less exposed to the market, to the fluctuations, and you still retain as much of your investment base as possible.
Hmm. I can't think of any strategy that is less exposed to the market because when I think of pre-construction, the risk there is you buy now, what if the price point is not there when you're selling? Rental market is also faced with like in a recession, people can't pay their rent, so you're also more exposed. Um, so what strategy are you thinking? Let me think through the question.
Uh, sometimes I'm thinking, okay, I'm looking at even just saying we buy and hold. Folks sometimes are on you have single family which have their own quirks and perks, but then there's a multi-family which you just literally definitely have to have a mortgage company oversee that, unless you yourself are doing janitor work or something like that. But even with that, they have their own. The general trend seems to be that when you get a property that cash flows a lot, for
Yeah.
example, like a multi-family, you have a 9 unit apartment, the cash flow might be high, but appreciation may not be that high.
Yes.
And the reverse is the case for like a single family. Depending on the neighborhood, you may just be barely breaking even, but over time appreciation could go up, right? But in all of that, I'm thinking, okay, long term, which one kind of plays well to a person who's like 50, 55? Because I do have some potential investors who are kind of thinking, okay, what do I do with my money that's a bit safe and secured but can still enjoy the boom of the market. The boom of the market is typically with those lower cash flow because they appreciate higher, but then you know, a retiree also wants to collect cash flow because they're not working anymore. So it's like, how do you find a balance in this kind of situation?
Okay. So I think it depends on what type of investor you are. And you mentioned a really good example. If your goal is cash flow because you want to be able to replace your income so you're able to retire, then cash flow is like the most important, even if they are not appreciating as much. Because
Hmm.
typically because they are not appreciating as much, also could mean that they are not going to depreciate that much because when the property when in quote there's a bubble. So
Hmm.
it's the most important is like replacements. I've seen people do Airbnb because There's more cash flow. I've also seen people buying multifamily because that means that once you are generating a certain income from that property, you don't have to rely on like a stable income, on a stable salary job. You can retire based on the cash flow. So if
Mm.
that's kind of the investor you are, then you don't focus as much on appreciation. You focus on more like cash flow and being able to replace your income with the rental income. And also
Mm.
like how diversified is. The thing about when you have a single family renter, like that particular renter, if they lose their job, they might not be able to pay you. And that means that during that time, you have to find a way to pay it, or you yourself, you're going to be in trouble. If
Yeah.
it's a multi-family, it's also like even though it's one building, it's diversified because the
Hmm.
chances of them all losing their jobs is much lower than the chances of one person in a single family. So it's also more diversified because of that. It's less risky to invest in a multi-family than a single family. But yes, over the last previous years, we've seen that single family also appreciates more because there are more types of buyers that fit into that than, but if that's the kind of person you are, you have to then plan your plan B. What's your plan B? If for some reason you are not able to sell at your right price and you want to hold it for longer, can you withstand that? You have to get a second job to be able to do that. If your renter cannot pay, what's your plan B? So I think you have to determine the type of investor you are and you choose your strategy based on that.
Very good. Now we're winding up close to the end of the show right now. Just a couple more things to talk about before we wrap it up. If you have any questions from our audience, please make sure you drop it in the comment section as soon as possible. Dammy, for a lot of people who are quite conservative financially, they think about, you know what, I want to just own my home, free and clear. You know, what's your take to that in terms of having for an investor, for example, who's just thinking about, owning a home, they want to pay it off early. What would you say to that?
When I see people that are very conservative, I feel like sometimes a lot of times it's also lack of knowledge.
Mm-hmm.
So I feel like sometimes you can educate yourself out of fear because you can start off being very risk averse. And I see a lot of people like that. And I ask, for example, why do you think this is going to happen? Oh, my tenant is not going to pay. I'm like, you as a tenant, were you paying your rent? I actually think there are more good renters than people that don't pay. In my and if that happens, how can you deal with that? You educate yourself. Maybe you want to have a paralegal that is also and you do your vetting process. So I'll say like when you have for people like that, identify exactly what your fear is. Where is it coming from? Sometimes it's also how you grow up with money. You're so afraid of losing something that you don't put yourself out there. And the only way to make money, you have to somehow put yourself at risk because the returns is actually based on the risk that you're putting out there. So I'll say if you are really afraid, you have to pinpoint exactly why you're afraid and you have to then research how can I deal with this? At least that's how I operate. How can I deal with this if my fear actually comes true, what can I do about it? Do you want to partner with someone so that you are less at risk? As an example, do you want to buy something that is much smaller in another province so that you're able to manage the worst case if it happens? So I think educating yourself out of fear, and even if after education you still don't feel like that's the right path for you and you want to pay your mortgage, that's also totally fine. But I always remind people if you're on a 3% mortgage rate and you have equity of 500,000, you want to put 500,000 into your property. Let's even use 100,000
Mm.
because that's more realistic. You want to put 100,000 to pay off your mortgage. What you are doing there, you're saving 3% per year by paying off your mortgage. Average returns of the stock market alone over a longer period of time is 8% per year.
Yep.
Real estate has done a lot more. So what's your opportunity cost? You think you are saving by paying off your mortgage because you're not paying interest, but you're actually really losing because the opportunity cost of that action is actually much higher because the money can be more productive in other markets. There are
That's
also
right.
some people that don't have income, they are closer to retirement. They don't want to be paying mortgage payments when they don't have income. Sometimes that could be a better idea. You could also pay off your mortgage. But if you're a more savvy investor, and you don't have to be savvy, or if you are willing to educate yourself or work with the right people, you can actually have other investments that are paying for your current home.
Hmm. So again, that That's really well said because the money you're holding on to, if you compare that growth, what you're saving to the inflation rate, you're almost losing money, right? So
Yeah.
let's talk about the worst case scenario. What's the worst that can happen that one is hedging against when they're trying to own their home free and clear, and how do you hedge against that if you were encouraging them to diversify and maybe take some of that equity and invest into another property? How do they stay safe doing that? Let's say maybe in the case of tenant not paying the rent. By the way, I agree with you that yeah, there are a lot more good tenants than bad ones. Really, that's just the truth. Yes, tenants are getting more savvy these days. They are knowing their rights the more. They are pushing back the more on tenant on landlords sometimes that are not so good. Some landlords really they just want to collect their rents and leave the house in shambles. That's not good either, right? So as investors, we often talk about what we suffer in hands of bad tenants, but we need to talk about us ourselves to doing our due diligence to make sure that we do right by our tenants. So back to the question then. So what are the ways to mitigate against some of these things or some of these fears of bad tenant or not paying, particularly on the financial side, because really the worst case scenario is that the bad tenant is not paying. um in terms of leverage, in terms of exposure, what would you say is the best way to protect yourself against that?
Okay. So I think I mentioned one of them. If you're afraid of one tenant not paying, maybe you should look at multifamily because it reduces the risk of that.
Hmm.
Because if you, let's say you have a single family, one tenant doesn't pay, you have to pay your mortgage payment. That could be very stressful. But if you have like a 5 unit property, one or two not paying, it means at least you can cover most of your payments. So that's one strategy. The second strategy is you can find other ways to make money, other sources of income beyond like just one set of income. So that allows you to be able to pull on that. You could also be having multiple properties because if one is in, God forbid, everything is in trouble at once, but it could be that you could pull on others when one is not really doing well because of tenant risk. And I would say the third is there are other ways to invest in real estate without having a tenant. Like we talked about flip. If you are someone that you really don't want to have to deal with any tenants, you can be in a strategy like where you are doing more flips. You can look into pre-construction. There are people that do wholesaling. So there are other real estate investment strategies that you can go into if your main fear is tenant risk and you just don't want to be bothered by that at all.
Yeah, that is well said. We're coming down to the end of the show now. Lots been said, a lot has been learned, and this is being streamed live, so it stays on Facebook and it stays on YouTube as well. So if anybody wants to revisit all that we've said before, feel free to rewatch, and please make sure to like and share and subscribe. And yeah, I believe we've gone through all that we looked to talk about today. Is there anything else you want to leave us with, Dami?
I think you got me thinking about people that want to pay off their mortgage. And I always say that the best way to be able to pay off your mortgage faster is really to invest a lot. Because if you are paying off, let's say you are paying, you get a new mortgage now for the next 25 years. You are paying your monthly payment. You are a salaried person. Let's say you start to make extra $300 payments. That probably shortens the amortization by what? 3 years. You are more likely to be able to pay off your mortgage if you diversify and later consolidate than being able to pay off your mortgage just by paying your monthly payments or even making a little bit of extra. So I would say you're better off investing to pay off your mortgage than paying like just your monthly payments. It will take you a longer time to be able to pay your mortgage than somebody else that is investing as multiple properties, appreciating, also as that rental income coming in, and then maybe consolidating in 10 years if that's really the main goal to be mortgage free. So sometimes you have to expand and then con- um, consolidate than just staying with that one property and making your monthly payments.
Right. Yep. That couldn't have said it better. You have say 500,000 to go, right? And you have, for whatever reason, you have 500,000 cash. Instead of dropping that on your house, you could literally get, I don't know, 3 to 5 properties with that 500,000 cash. They all appreciate, and you can I'm trying to put it in the layman term. So basically, consolidation means that now you can sell off the others and get the equity from all of them, pay off the one you want to pay off, and that could probably be done in like 6 7 years
Yeah.
rather than the 30 years, or well, 27 years, because you're now paying extra $300. Well said. Thanks a lot for dropping that again.
Very
It's
much.
been awesome having you on the show. Could you tell our audience where they can reach out to you on social media if they need your services?
Yes, typically always on Instagram, so I'll say that's the best place to find me.
Hmm.
My handle is Mortgages by Dammy. You can also send me an email at hello@mortgages by Dammy. Or you can schedule a meeting with me. I really am passionate about real estate, so you can schedule something with me. I'm on talently.com/mortgages by Dammy.
Thanks a lot for that. You heard that. So just jump on Instagram, search Mortgages by Dammy, and she's right there. And I tell you again, just going down her feed alone, you would see that there's a lot to learn, and she would really bring you value if you're hiring her as your mortgage agent. Thanks a lot, everybody, again for coming on the show today. It's been an awesome time. I've learned a lot, and it's always fun for me talking real estate. So I'm a realtor here in Southern Ontario. I'm also an investor. If you're looking to invest, you're looking to buy, looking to sell, you just have any questions at all, feel free to reach out to me as well. It's Joseph Ola on Facebook, on Instagram. I'm also there. And yes, it's been an awesome time today. Thanks a lot for joining us. Thanks a lot, Dammy, again for coming on the show.
Thank
And
you.
hopefully we'll have you back sometimes, and we'll just talk about your investment portfolio. Maybe that's what we'll do the next time you come on the show.
Definitely. Thank you very much for having me. It's been a fun conversation.
Same here, same here. All right, okay, everybody. It's gonna be the same place, same time next week, Monday at noon EST. Looking forward to having everybody back on the show. Thanks a lot for coming out today. Have a blessed one. Bye.